What if I told you the biggest threat to the US dollar right now isn't China dumping treasuries, isn't the Fed losing control of inflation, and it's not even the national debt? It's Japan. A country that most Americans haven't thought about since the 1980s. A country that looks, on the surface, completely stable, quiet even. But underneath that surface sits the single largest pile of government debt in the developed world. Debt so enormous, so tangled into the global financial system, that if it starts to unravel, you'll feel it in your 401k, your mortgage rate, and the dollar in your wallet. And here's the terrifying part. Almost nobody in mainstream financial media is connecting these dots. So today, we're going to walk through exactly what's happening, how Japan built a financial time bomb over 30 years, how that bomb is wired directly to US bond markets, and what happens to ordinary American investors when it finally goes off. Stay with me through this whole video, because the ending, the part about what you should actually do, is the part most finance channels never tell you. And if you haven't subscribed yet, do it now. We cover this kind of macro-level financial storytelling every week, the stuff that actually moves markets, explained in a way that makes sense. Let's start with a number that should stop you cold. 260%. That is Japan's government debt as a percentage of its GDP. To put that in perspective, the United States, a country everyone loves to panic about because of its debt, sits at around 120%. Greece, the country that nearly broke the entire Eurozone in 2010, peaked at around 180%. Japan is at 260%, and it has been climbing for 30 years. Now here's the thing. For most of those 30 years, economists and analysts kept predicting that Japan would collapse under the weight of this debt. They wrote articles, they made predictions. Some of them shorted Japanese government bonds so aggressively that traders started calling it the widowmaker trade, because everyone who bet against Japan eventually got destroyed. Japan didn't collapse, and that's exactly what made it so dangerous. Because while the world watched Japan survive the impossible, Japan quietly became the single largest foreign holder of US Treasury bonds on the planet. Larger than China, larger than the UK. Japan is sitting on over $1.1 trillion in US government debt. Think about that for a second. The country with the most explosive debt load in the developed world is also one of the primary lenders keeping the United States government funded. That is not stability. That is two tightrope walkers holding each other up over a very long drop. So how did Japan get here? How does a country accumulate that much debt and still function? And more importantly, why does any of this matter to you sitting at home watching this video in America? Here's where the story really starts. Go back to the early 1990s. Japan had just experienced one of the greatest asset bubbles in modern history. Real estate and stock prices had soared to insane levels. At the peak, the land under the Imperial Palace in Tokyo was theoretically worth more than the entire state of California. Then the bubble burst, hard. What followed was what economists called the lost decade, except it wasn't one decade, it was three. Japanese economy stagnated, deflation took hold, meaning prices were actually falling year after year, which sounds great until you realize it causes people to stop spending because they expect things to be cheaper tomorrow. Businesses stopped investing, banks stopped lending. The Bank of Japan, Japan's version of the Federal Reserve, did something radical. It slashed interest rates to zero, then below zero. It started buying its own government bonds by the trillions. The official policy became this: we will do whatever it takes to keep rates low and pump money into this economy until it starts growing again. And here's where things get weird, because what the Bank of Japan accidentally created was a financial mechanism that would eventually stretch its tentacles all the way to Wall Street. Here's the mechanism, and pay close attention because this is the engine behind everything. When interest rates in Japan are at zero or even negative, Japanese investors, insurance companies, pension funds, and banks face a brutal problem. They can't make any money at home. Your money sits in a Japanese government bond earning essentially nothing. Sometimes you're paying the government to hold your money. So what do? You go looking for yield somewhere else. And where's the place with the deepest, most liquid bond market in the world with relatively attractive yields? The United States. Japanese institutional investors, we're talking pension funds managing the retirement savings of millions of Japanese workers, life insurance companies with obligations stretching decades into the future, these players started moving enormous amounts of capital into US Treasuries and into US mortgage-backed securities and into US corporate bonds. Think of it like this. Imagine the global bond market is a giant water system. Japan is a reservoir sitting at a very low elevation, and the United States is a reservoir sitting slightly higher. Water, capital, flows from low yields towards higher yields. For 30 years, Japan has been pumping water into the American financial system. This is called the carry trade. You borrow money cheaply in Japan, convert it to dollars, invest in higher-yielding American assets, and pocket the difference. It's been one of the most reliable wealth-generating machines in global finance for 30 years. Now here's the question that should be making you uneasy right now. What happens when Japan turns off the pump? This is where the story takes a turn, and it's a turn that's already beginning. For the first time in over a decade, Japan is facing real inflation, not the mild, we wish we had more of it inflation they were chasing for 30 years, real uncomfortable inflation, the kind that erodes living standards, the kind that central banks are supposed to fight by raising interest rates. And so, after years of holding rates at or below zero, the Bank of Japan has started raising them. Slowly, cautiously, the way you defuse a bomb while wearing oven mitts. But the direction is clear. The era of free money in Japan is ending. Now watch what happens next, because this is the chain reaction most people completely miss. As Japanese interest rates rise, two things happen simultaneously. First, Japanese investors can suddenly earn a real return at home. Why take on the currency risk of holding US dollar assets when you can park money in Japanese bonds and actually get paid? The incentive to chase American yields starts evaporating.
Second, and this is the one that keeps macro traders up at night, the Japanese yen strengthens. Because when rates rise, money flows into that currency. And when the yen strengthens against the dollar, any Japanese investor holding dollar-denominated US Treasuries faces a currency loss that wipes out the yield advantage entirely. So Japanese pension funds, insurance companies, and banks start doing the math. And the math stops working. And when the math stops working, they sell. Over $1 trillion in US Treasuries, potentially hitting the market. Now look, markets are big. The US Treasury market is the largest and most liquid in the world. But here's the thing about bond markets. They move on the margin. You don't need everyone to sell. You just need enough sellers to show up at the same time that buyers disappear. And when Treasury prices fall, which is what happens when people sell them, yields go up automatically. Rising Treasury yields mean rising borrowing costs for everything in America. Mortgages go up. Car loans go up. Corporate debt refinancing becomes more expensive. The federal government's own interest payments, already running at over $1 trillion a year, balloon even further. Think about a Jenga tower. The global bond market has been stacked, block by block, on 30 years of cheap Japanese money flowing into U.S. assets. Pull enough of those blocks out and the whole tower wobbles. And here's where the dollar comes in. There's a second-order effect here that almost nobody explains properly. The US dollar's status as the world's reserve currency depends, in large part, on global demand for dollar-denominated assets. Countries and institutions hold dollars because they hold US Treasuries. It's circular, self-reinforcing, and extraordinarily powerful. But it's not magic. It requires continuous demand. If Japan's institutional investors begin a sustained rotation out of US Treasuries, even a slow, methodical one, it represents a structural reduction in foreign demand for dollar assets, not a crisis tomorrow, but a slow erosion of the foundation. And here's the scenario that actually worries serious macroeconomists. It's not an orderly, gradual rotation. It's a disorderly one. In August 2024, we got a preview. The Bank of Japan raised rates unexpectedly, the yen carry trade partially unwound, and in a single week, global equity markets sold off hard.
The S&P 500 dropped nearly 10% in days. Credit markets flashed stress signals. It was a tremor, not the earthquake, but it showed exactly how sensitive the system is. Now, you might be thinking, okay, but Japan's been in trouble for 30 years and nothing catastrophic happened. Why is this time different? Fair question. And here's the honest answer. This time, the trigger is different. Japan has lived through 30 years of zero rates because it had no inflation to fight. The Bank of Japan could keep the game going indefinitely, but inflation changes the calculus entirely. It removes the central bank's choice. You cannot let real inflation run in your economy without raising rates, not without destroying your currency and your population's purchasing power. The Bank of Japan is no longer choosing to normalize rates. It's being forced to. And the scale of what gets unwound matters enormously. We're not talking about a hedge fund or a mid-sized sovereign wealth fund. We're talking about the largest pension fund in the world, the Government Pension Investment Fund of Japan, with assets exceeding $1.5 trillion, heavily weighted toward foreign bonds. We're talking about Japan Post Insurance, Nippon Life, Dai-ichi Life. These are entities that move slowly, communicate policy changes, and try not to panic markets. But they all answer to the same fundamental math, and the math is changing. So what does this actually mean for you? If you're in your 30s, 40s, or 50s, investing for retirement, carrying a mortgage, running a business, here's what you need to take away from this. Interest rates in America are not purely in the Fed's control. Foreign capital flows matter, and the largest single source of that foreign capital support is Japan, and it is, for the first time in a generation, in the early stages of reversing course. That doesn't mean you sell everything and hide in cash. That would be the wrong takeaway. What it means is that the era of reliably declining long-term interest rates, the era that made bonds a safe haven and juiced stock valuations for 40 years, that era has a structural new headwind that wasn't there before. It means long-duration bonds carry more risk than they used to. It means mortgage rates staying high isn't just a Fed policy problem. It has global structural components. It means the dollar's strength, which many Americans take as permanent and inevitable, is actually contingent on the continued willingness of foreign governments and institutions to park their savings in dollar assets. And that willingness is being quietly, methodically reassessed right now in boardrooms in Tokyo. Here's the bottom line. Japan's debt situation isn't a distant problem in a foreign country that doesn't affect you. It is wired directly and mechanically into the cost of your mortgage, the yield on your bond fund, the valuation of your stock portfolio, and the long-term purchasing power of every dollar you earn and save. The bomb isn't going off tomorrow, but the fuse is shorter than it's ever been. And the wise move isn't to panic, it's to understand the mechanism so that when the tremors come, you're the person who is not asking what just happened, you're the person who already knew. If this video helped you see something you hadn't seen before, share it with someone who needs to hear it. And drop a comment below. I genuinely want to know, are you concerned about what's happening in Japan? Are you adjusting your portfolio at all? Because this conversation is just getting started.